In this video, we're going to talk about the classified statement of financial position, or in other words, the balance sheet or the classified balance sheet, or even like the consolidated balance sheet. Once again, we have different terms for the same thing. So essentially, the main accounting equation within the balance sheet is assets equals liabilities plus shareholders' equity. Now we're going to take these three accounts and we're going to split them up into more categories now. So assets could be split up into 5 categories. We have current assets, then we have long-term investments, we have property, plant, and equipment, intangible assets, and goodwill. So essentially, current assets are those assets that are due within 1 year. These include things such as cash, held for trading investments. So held for trading investments are in unique current asset. So these are investments that we have that can be sold within 3 months. So let's just say, for example, we have cash laying around. We're like, you know what, like this cash isn't doing anything for now. Let's just go out and buy the shares of Apple and let's just earn some income off of it. But we could sell it at any time. We could sell the shares of Apple at any time to pull the cash out, and we could spend it in our operations of the business. Then we have accounts receivable. Then we have notes receivable. That's less than 1 year, right? If the note receivable was more than 1 year, that'll be labeled as a long-term investment. Then we have inventory, we have supplies, we have prepaid expenses. Then we have long-term investments, which includes things such as equity and debt investments being long-term notes receivable. Then we have property, plant, and equipment, which includes land, building, less accumulated depreciation building, equipment, less accumulated depreciation equipment. Then we have intangible assets, which are those assets that have no physical substance, but they still give us some sort of value. Then we have goodwill. Goodwill arises when we purchase out another company for what it's actually worth. So if the net assets, meaning like if a company has assets of, let's just say $1 million, they have liabilities of 200,000. That means the company is worth 800,000, but we pay $1.2 million for that company. The extra 400,000 is goodwill. Goodwill is essentially the company's brand name, the company's reputation, the company's customer base, etc., because they're already a well-established business. Then we have liabilities and shareholders' equity. So liabilities is broken down into 2 components. We have current liabilities, anything less than 1 year. Then we have long-term liabilities, which is anything more than 1 year. So current liabilities includes things such as bank indebtedness, accounts payable, unearned revenue, notes payable, that is less than 1 year. And then we have current maturities of any long-term debt. The non-current liabilities could be bank loan payable, notes payable for more than 1 year, bonds payables, things like that. Shareholders' equity has no classifications. It's just share capital. Remember, share capital is another word for common shares and preferred shares. And then we have retained earnings.